Welcome to the Sidebar with a CFP. Pierce the veil on BigLaw Life, career, and money. Hosted by Matt Smith, the tour manager for BigLaw attorneys. You bill in 6-minute increments. Let's get you some of that time back. In each episode, we will have candid conversations about life inside Big Law, the real stuff they don't teach in law schools or show in recruiter brochures. This show pulls back the curtain on what it actually feels like to climb the ranks, navigate transitions, and make big decisions in a high-stakes career. You'll hear from partners, associates, and experts across law and finance, each sharing stories, surprises, and strategies for building a life and career that works for you. This isn't a money podcast. It's a Life in Big Law podcast with a CFP in the host chair. The contents of this podcast are purely intended to be general and educational in nature and should not be construed as specifically tailored investment, financial planning, tax, legal, or other professional advice. Any investment performance referenced is purely past performance, which is no guarantee of any future performance. Nothing contained in this podcast should be construed as an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or other financial product or investment strategy. All investment, tax, and financial planning strategies involve risks that you should be prepared to bear. You are highly encouraged to consult with professionals of your choosing before taking any action based on the contents of this podcast. To the extent the guest on this podcast was a client of Concert Financial Planning as of the date of the recording, the guest was not compensated for their time. Nothing conveyed by the guest should be construed as a testimonial or endorsement of Concert Financial Planning, and their experience as an investor or a client may not be representative of all investors or clients. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, iHeartRadio, and on our website, concertplanning.com. Now here's the host of Sidebar with a CFP, Pierce the Veil on Big Law Life, Career, and Money podcast, Matt Smith.
Hey everybody, welcome to another episode of Sidebar with the CFP, where we try and pierce the veil, go behind the curtain on life in big law. That's your career, that's your personal life, that's your money in particular, and try and talk about how things can overlap when it comes to your investments, your money, your broader financial picture, and that career that you've worked so hard to get into, which is big law. Today's episode is really special for me because I have not only a colleague, but dare I say a friend that I've made over the years working together in our respective capacities, mine in financial planning. And this person is one of my ultimate go-to tax experts, where we share a number of mutual clients, and I have the utmost trust and have a great working relationship. So I'd like to introduce Demetrio Vargiu. Demetrio runs Vargiu Professional Services in the Houston area, which is a tax preparing and tax advisory firm. He's licensed certified public accountant with a BBA in accounting from the University of St. Thomas in Houston. He's more than 20 years experience in the public accounting field, and his work experience includes federal and state taxation, accounting, and business advisory services. So, Demetrio, thank you very much for being here. I appreciate it.
Thanks, Matt. It's my pleasure.
So I reached out to you initially to do this a little while ago, and one of the big things we had to avoid was the April tax season. So as we record this, it's May 12th. How much time do you need to take for yourself after that April 15th deadline? Hopefully at least a week or two.
You know, the last few years, as my firm grows, the time that I take after when tax season ends, it's getting shorter and shorter. But I took about 10 days off, and during those 10 days, I was getting phone calls nonstop. So eventually, I said, let me just go back to the office and keep working.
Yeah, it's like it never stops. It just starts building up, and I'm sure builds anxiety. So your practice has been growing. Tell us a little bit about your practice, what it looks like, what you do.
Yeah, so I've started my practice back in 2014, and I just started it out of my house, and I was working for a bigger firm here in Houston, Texas, and I worked for them for a number of years, and I was I was running a tax department, and eventually I just said, well, let me try this on my own. So I started off, I was working out of my house. I used to drive and meet people at Starbucks or
Mhm.
anywhere they would like and pick up documents. I would pick documents up from their house, prepare their tax returns, and deliver them back to their house. And I did that for a few years, and I was able to get enough clientele that I was able to rent an office space, and it's just continued to grow year after year, especially the last 4 to 5 years.
Yeah, that's great. I've been happy and excited to work with you on a number of different cases and different types of clients. And it's a funny, like we both started from the ground up with zero
Mhm.
existing clients and working out of the house and all that. So yeah, congrats on making it over a decade at this point,
Thank you.
and being so good at what you do. So let's talk a little bit about what you see from your angle when it comes to clients and their obvious distaste for paying taxes. I know in my world, I focus on big law attorneys. They're either associate attorneys that are paid a regular salary and bonus on a W 2, or they may be an equity partner where they're paid K-1 income and maybe they owe state taxes in a variety of states and things like that. The common thread is that they are all getting hammered in taxes because they have a great problem of making a lot of money.
Sure.
And often some of them come to me just to run a strategy by me that maybe they heard from a friend or they heard through some form of media or something. um, can you talk a little bit about strategies that are maybe applicable to high income earners to help reduce their tax burden that are not maybe what they're seeing on TikTok, things like that?
Well, so I think when you look at clients and how effective they are by paying high taxes, I think one of my jobs is to learn a client first of all.
Mhm.
So if you have a new business client who hasn't made a substantial amount of money in the past, and then they have that breakout year, they're usually very shocked once they get that tax bill.
Yeah.
But what you'll find is after a few years of earning that type of income and being in a higher tax bracket is you just have to get comfortable with it, and you have to understand that if you're making money, you're going to pay tax.
Yeah.
Now the position we want to put you in is to pay the least amount of taxes as possible. Now, my clients, I have a wide range of clients, business owners, and then of course most business owners have what we call flow through entities nowadays, meaning that the K1 is going to pass down to the individual level. So when you
Mhm.
have a client who is a business owner, there's a lot more opportunities for tax planning and strategies to try to, for example, if you have a business, one of the things that I do is when I'm running tax planning is, we look at what bracket you're in. If you need to invest back in your business, potentially buy some equipment, buy a vehicle, and if that's going to drop you from the 32 to the 24% tax bracket, well, then that's going to be a strategy that I'm going to suggest, right? Because that's a big
Yeah.
jump in the tax brackets. But when you're dealing with W-2 income earners, it gets a little more complex because you cannot, back in 2017 when they changed the tax laws, you cannot deduct any expenses against W-2 income. That form 2106 is gone now. So what's on the W-2 is on the W-2. Then a lot of high income earners who are W-2 employees, well, the other income they're probably going to have is investment income. So that's where I'm going to go. I'm going to work with the financial advisor to see if there's any strategies there where we can limit their investment income.
Yeah.
Uh, Now, when you're looking at a W-2 employee, really what you want to look at is what type of plans does the employer offer, right?
Mhm. Mhm.
401ks, HSAs, dependent care expense. You can withhold 5,000 there. So high income earners usually going to phase out if they have young children. They're going to phase out of the dependent care credit. But if you can get that deduction directly on the W-2 of 5,000, well, then they're able to capitalize on that deduction. So really, when you're dealing with high income W-2 earners, we're really looking at what does the employer offer, and then we're making a suggestions there where they tap into those different programs, and hopefully and you're not going to get a huge deduction, but if you take advantage of each one of those programs, it will help out, overall.
Yeah, I'll piggyback on what you're saying, and for my associates that are listening, There may be what are called cafeteria plans in addition to your retirement savings accounts. And cafeteria plans are things like maybe your company will allow you to put money away on a pre-tax basis to pay for parking, or
Sure.
if you use public transportation, you can do that. And a lot of these things are not going to be large dollar amounts every year, but when you put them together, you can start to see maybe a more meaningful impact on your overall tax situation. And it's what's interesting is a lot of people don't initially think that when they're making their employee benefit elections in the fall, that that can spill over into other areas of your life, like risk management with insurance and things like that, but also your taxes. Electing the high deductible health plan that has the HSA account, maxing out the 401k on a pre-tax basis, using some of these ancillary benefits like the flexible spending accounts that you can use and qualify for, and the cafeteria plans if they're available. What I find is that oftentimes a client may have heard something about, well, I can use real estate to offset my income, or like you mentioned, purchasing a car for a business owner. And some of these things just really don't apply to a W
Yeah.
2 earner because of all the nuance of the rules in order to qualify. Um, but yeah, you mentioned, working with business owners. We have at least one shared client that is a business owner, and that feels it gets very complex very fast. But there are a lot of opportunities and things that we can do with business owners in particular.
Yeah, yeah, and that is one question that I get asked numerous times each year, where high income W-2 earners, they either hear from a friend or they hear something on social media where they feel like if they've been given advice to go out and buy a rental property, and they think the loss on the rental property is going to offset their W-2 income, and that's just not the case. Once your AGI goes over 150,000, any losses on a rental property are going to be suspended and carried forward, and they'll continue to be carried forward, so you don't lose those losses. You can capitalize on them in the year that you sell the property, but on an annual basis, it's going to provide you zero tax benefit. So
Yeah, yeah. The real estate thing in particular, I think often people are surprised to find out that there are rules about like whether you're an actual real estate professional, how many hours that you have to have been working in like managing real estate, for example. And if you're the attorney in the family, it's going to be super hard to convince
yeah,
an auditor from the IRS that you spent, whatever the number is, 750 or 1,000 hours
so 50.
working in the real estate business when you just build 2,300 hours, as an attorney. I will say I do have an active client situation now where this actually is a more feasible thing because there is a spouse that is currently staying at home who is interested in real estate and is
Sure.
interested in managing properties. And it's not necessarily a burden for her to go start managing these properties on a bona fide legitimate basis. And in that case, I think the real estate thing can really work for some people.
Yeah, you're absolutely right. And I have a number of clients with the wife the wife stays at home, and the rule is that either spouse can qualify with that 750 hours. So I have a number of clients that they are able to use that strategy, and it does benefit them. And we do that by the wife qualifying as a real estate professional rather than the husband working.
Yeah.
working.
So that's got to be a painful mistake to learn about after the fact. If you're someone who has gone and bought a short-term rental thinking it might offset your W-2 income, and then comes tax preparing time and you discover that it really didn't. And speaking of mistakes, one of the first clients that you and I worked with together was someone whose prior tax preparer was also serving as their financial advisor, and frankly wasn't doing a great job at either one of them. And we actually found a situation where they had overpaid their taxes by $30,000 because
Mhm.
the prior tax preparer had made a mistake and had them had them double pay. um, and that was a case where you went and filed the amended returns in order to get them their money back. What have you seen other kinds of mistakes and errors that people may make if they're doing it on their own or working with somebody that doesn't really know what they're doing?
Yeah, definitely. I mean, that one particular mistake was an AMT issue. But I find that all the time, especially with other tax preparers, people coming over from other firms. There's not any specific area. that I can kind of pinpoint and say this is the mistake. I guess if I had, well, if, I guess if I had to mention one, the QBI. So back in 2017, they came out with the qualified business income deduction, and that's basically a 20% deduction on the net income of a business, where the government will just give you that deduction for free. And on the, whether if it's a Schedule C filer, there's just a button on that form that you check that says, does this income qualify for QBI? And a lot of people who are preparing their own individual returns, they probably look at that question, have absolutely no idea what it means, and
Right.
they'll check no. And then when I get to look at their return, and I think I've amended 3 returns here in the last couple of weeks of clients who came over to me as new clients for the 2025 tax season, where I was able to notice that they didn't capitalize on that QBI deduction. And then I was able to go back and amend the returns and grab that 20% deduction for them.
That's got to be such a rewarding feeling for you to show a client that immediate turnaround, 20% of net income
Sure.
for a business. I mean, that's huge. Um, so we're now kind of between April and the October extension deadline. A lot of my clients wind up needing to file extensions either because they're paid a K1 as an equity partner and it's just delayed, or they have investments that have delayed K1s, or for numerous reasons they may have to do that. And a lot of times they are a little apprehensive about that. Is there any reason to be concerned about filing an extension and filing your taxes in October?
No, I think that's a misconception. I mean, I have a lot of clients who they do not want to file an extension, and I think it just comes from somebody telling them in the past that if you file an extension, you're going to be more susceptible to an audit. And I have not seen any inclination of that in my 20-year career in this field.
Mhm.
So I think that's a misconception. An extension is there for a reason, and when you get into high income clients, most clients aren't going to be able to file by April 15th because they don't have all the K1s. They don't have the K1s yet available to file. So I think that's a misconception. I see no evidence of any audits coming in, for anybody who's filed an extension. Now, I will say this, and I've been in business for myself for 14 years, and I've had a low audit rate, and I just try to make sure that, I have people who show up, they want to do things that make me uncomfortable, and
Mhm.
I will not take those clients on, because I do feel that if you start doing that for particular clients, and if you do get an audit, and you get on the IRS's radar, and they see what type of work you're doing, I feel like they will go in and grab a bigger bunch of your clients, and maybe audit them. So I mean, there's always gray area in tax, but I try to I don't do anything that makes me uncomfortable. And I also don't do anything that's going to expose my clients to an audit if I make a bad decision and try to, please one client, and
Right.
not look at all of my clients as a whole.
Yeah, it's such a good point. I think we have a lot of overlap in that from the outside looking in, it probably looks like our respective jobs are pretty binary, mathematical, formulaic, a hard science, so to speak. And I'm always trying to explain to people that really, in many cases, it's a soft science, it's a judgment call, it's how do we interpret X, Y, or Z. And particularly on the tax side, if someone wants to air quote get creative with their taxes, they'll probably be able to find someone to sign that return for them and
Absolutely.
supposedly sign off on it. But at the end of the day, correct me if I'm wrong, if the IRS comes after a tax filer, like not a tax preparer like you, but just the end individual who's filed their taxes and done something inappropriate, they can't use an excuse like, well, my CPA said I was allowed to do that. That's not a defense for
No,
something.
no, it's not. I mean, the burden of the proof is always on the taxpayer. So if no matter what I do on a return, when I finalize a return, the return is sent out to the client. The client is encouraged always to do their own review of the return.
Mhm.
And once they accept the work that's been done. Well, now, if they have any questions, if we need to go over anything after they do their review, I'm always open to that. But once they sign the 8879, then they've given the approval that they agree with the work that's been done, and the return can be sent to the IRS. And if an audit occurs, and if something, if an issue arises, they're not going to have any recourse by pointing the finger back at the tax preparer. It's gonna fall on them. Now, if I ever make a mistake on a return, I always, and nobody's above making mistakes. I've made mistakes in my I've made mistakes in my career.
Yeah.
Now, if I've made a mistake, then it's identified by the IRS. Well, the tax is always the client's, right? So if the return would have been done correct the first time, well, then you would have paid that tax. But I always cover the penalty and interest because it's my mistake, and I just do
Yeah.
that out of good faith.
Yeah, good. And I think that's important. And of course, nobody is perfect at all times, especially over 20-year career. But that's something I want to hammer home for any listeners is that um, at the end of the day, it's not any kind of defense to the IRS to say so and so professional told me I could do this. The IRS
Mhm.
isn't going to care. And I think you alluded to this a minute ago, but it's my understanding that contrary to I'm going to say common law, that's probably not the right term to use, but contrary to the type of law that we're all familiar with as lay people, when it comes to the IRS, the burden of proof is on us as the tax uh, payers. If the
Absolutely.
IRS comes to me and says, "We think that you're wrong and you owe more money," it's the burden of proof is not on the IRS to make their case against you. It's on you as the taxpayer to
Yes, sir.
prove to the IRS that they are wrong, which is contrary to I think what people would intuit.
Yeah, yeah, absolutely. I mean, they can make a determination, and then you have to fight that determination
Mhm. Mhm.
and provide support. So anytime we get into one of those areas where it's a little bit gray and we have to make a decision, I will always walk the client through. Here's what we'll do. If the IRS comes back, here's what potentially could happen. But we're going to build a file, and we're going to build a file with support on why we're making this decision, and then we'll keep that in the file. So in case if an audit does happen, but like I
Yeah.
said, I think I've had 3 audits in the last 20 years, so I have a pretty good um, record at this
Yeah,
point. So
yeah. Good. Well, I hope listeners don't take that as a numbers game that you want to
no,
risk it.
yeah,
I've come across tax firms and tax preparers that do treat it as a numbers game, and they just say, "Hey, if you get audited, you're busted, but you may not get audited." And I just think that's very unwise. All right. Well, let's move over to maybe a more positive side of the discussion, and I'm off the top of my head. I'm going to rapid fire some things that I would recommend um, people take advantage of depending on how they are paid. So, are you a W 2 associate? Are you a K1 equity partner? Or do you own your own law practice? I have a few clients that own their own law practice. And starting at the W 2, where in my opinion, there are the fewest um, strategies available to you to reduce your income, it's really, like you said at the beginning, focusing on what you can do through work,
mhm,
maximizing the retirement plans at work, using the health savings account and high deductible health plan, the cafeteria plans like transportation and commuting deductions, the flexible spending account. If you have children, you can use a dependent care FSA. If you don't have children, but your firm offers a limited purpose FSA, that is a flexible spending account that can be used in conjunction with your health savings account. Your health savings account will cover medical expenses. The limited purpose flexible spending account will cover things like dental and vision, and those
mhm,
don't conflict with each other. You have to be
mhm,
really careful not to choose the healthcare flexible spending account if you choose the HSA route.
okay,
Um, and other than that, the things we're doing on the investment side, we are doing practicing what we call tax allocation, tax location, where your high interest bonds are generally kept out of your taxable brokerage account because
mhm,
these things are paid interest that is taxed at ordinary income rates. And
mhm,
because of that, we want to put those into tax protected accounts like your 401k.
mhm,
We want to put the most tax efficient things into your taxable brokerage account. Usually that's things like US large companies that when they pay a dividend, it's a what's called a qualified dividend. It gets
Qualified.
favorable tax treatment. Yeah.
Yeah.
Um, I don't know. Is there anything really to add? I'm not sure. I just kind of went on a little soliloquy there, but
No, I mean, I think you have the right idea. I mean, qualified dividends are taxed at 15%, and then you also have long-term capital gains that
yeah,
are going to be taxed at 15%. And I see clients all the time. They'll have gains in a stock and they'll sell them at the 11th month mark. And it's, if somebody was advising you, you could just hold on to that 1 month, one more month, and you would have had a better tax benefit. So,
yeah.
but yeah.
Yeah, we have filters and alerts in our systems that warn us like, hey, you're about to sell something that is still short term, but it's within X number of days of long term. Do you really want to
Sure.
do this? That's funny. Moving to the K1 side, something that I see a lot. An attorney's entire financial life is turned upside down when they go from associate to equity partner, just because the way that they're paid dramatically changes. Benefits at work dramatically change. You may be used to having the 401k deferral that you've been doing for the past 5 or 10 years as an associate, but then other aspects of the 401k plan can open up to you, like profit sharing and maybe even after tax contributions. A pension plan might be
Mhm.
available for partners. But one of the things that trips people up the most, and I know it was true in my own family, is all the state tax filings that could apply to you if your law firm is doing business in multiple states across the United States and you're an
Mhm.
owner of that law firm. You could have these tax liabilities in all these other states. Can you comment at all about the added complexity that comes with having to file state tax returns in multiple jurisdictions around the country?
Yeah, I mean, I have a number of attorneys who work for larger firms, and the K1s come in, and some of these K1s, I mean, we'll have 10 different states. So, when you're looking at state returns, the first thing you want to do is to see if they qualify, if they have a requirement to file a state return, right? So,
Mhm.
what is the income threshold that's going to force you to have to file a state income tax return in this particular state? So, we'll look at the K1s. If they're over that threshold, then 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 you got to go in, and you have to, for the most part, you have to look at the rules because every state is different. I have a number of attorneys right now who receive K1s, and we're filing state returns in California and New York. I think California and New York are the most complex states to file state income tax returns. But they also, a lot of the bigger firms now, uh, it's the term is slipping. uh,
The composite filing
the
or
composite filing.
the PTET? Yeah.
Or the PTET, yeah. So you can actually be included in that firm's filing, and it would relinquish your obligation not to file a state return.
Yeah, and I've found that there's trade-offs with that in terms of like what tax rate you might pay along the way during the course of the year. But I think a lot of times what people don't think about is, well, if they, somebody, a colleague may warn the person, hey, if you opt into this certain type of filing at the state level, you're going to pay the highest marginal tax rate that
Hmm.
state has, and maybe you don't actually owe that much, so you're
Sure.
paying too much along the way, and it gets them a little bit scared about opting in. But on the flip side, it's like, well, do you really want to have to pay to have, another dozen tax returns prepared and all the
Yep.
complexities and potential, issues that could arise with that? Sometimes it's really worthwhile to go ahead and take the simplistic route and, you know,
Yeah.
get those things done. Let the firm deal with it. In a lot of,
Yeah, I would say on my end, it's about 50-50. About fifty
yeah,
percent of them opt in, 50% I go ahead and file the state returns. And then if
yeah.
and then a lot the partnership will pay the tax in for you. It's just a matter of claiming it as a refund.
Oh, okay. All right.
Yeah.
Cool.
Yeah. Yeah.
That's a fun fact. All right. And so then moving on to the law firm business owners, in my opinion, this is probably where there's the most flexibility as the owner of a company, whether you're elect to be taxed as an S corp or just a Schedule C pass through or whatever it might be. It seems that there are a lot of ways to use bona fide expenses to grow your firm, pay your people, do your things to really mitigate tax impact. And I even have a couple where the one spouse is in big law, uh, getting the big law income, and then the other spouse has opened their own. private law firm, and they've actually been able to use some of those early year losses in the law firm to offset
Absolutely.
some of the income for the family. So that's been cool.
Yeah. Yeah.
Well, Demetrio, thank you so much for being here. I appreciate it. Where should people find you if they want to look you up and reach out to see if you're taking new clients, that sort of thing?
Well, you can find me at www.vargiu-cpa.com. Um, I'm not on any social media, so you can't find me there.
Good for you.
I built my business over the last 13 years just through word of mouth. So I
Yeah.
would tell them if they don't find me through my website, they can contact Matt.
Okay, cool. Yeah. So that's vargiu-cpa.com, and Vargiu is spelled Vargiu for those that
Yes,
are
sir.
not watching and are just listening.
Yes, sir.
Yeah. And then you can find me at concertplanning.com. And Demetrio is somebody that I work with on a lot of different mutual clients and have a great relationship with. So thank you so much for being here. Really appreciate it. And look forward to continuing to work with you in the future.
Yes, sir. Thank you, Matt. It's been my pleasure.
You've been tuning into Sidebar with a CFP. Pierce the veil on Big Law Life, Career, and Money with Matt Smith. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, iHeartRadio, and on our website, concertplanning.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others. The contents of this podcast are purely intended to be general and educational in nature and should not be construed as specifically tailored investment, financial planning, tax, legal, or other professional advice. Any investment performance referenced is purely past performance, which is no guarantee of any future performance. Nothing contained in this podcast should be construed as an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or other financial product or investment strategy. All investment, tax, and financial planning strategies involve risk that you should be prepared to bear. You are highly encouraged to consult with professionals of your choosing before taking any action based on the contents of this podcast. To the extent the guest on this podcast was a client of Concert Financial Planning as of the date of the recording, the guest was not compensated for their time. Nothing conveyed by the guest should be construed as a testimonial or endorsement of Concert Financial Planning, and their experience as an investor or a client may not be representative of all investors or clients.